Property investing is completely misunderstood by most people. There are so many misconceptions about it. And yes, this is a crypto channel, but I always talk about diversifying across asset classes, right? Also owning some bonds, some stocks, some precious metals, besides the Bitcoin investment. And property is a nice diversifier. But the issue is most people have this completely backward. Most people think that when you're buying a house, you have something very tangible, right? You're buying a brick and mortar investment. You can always use it. You always have rent income. Pretty much the safest of the investment. But I don't think so. Property is one of the most highly levered investments anywhere. And property is highly financialized. If you are buying a flat somewhere in the city center of New York, and you're living in this shoebox, right? Are you really paying the millions and millions of dollars because of the construction materials around it? Of course you don't, right? What you're actually paying is the financial cash flows that apartment could generate in the future. So you're not buying brick and mortar. You're not buying the tangible thing. You're buying the intangible thing of future cash flow. Very similar to stocks, right? You're buying stocks because of their future dividend. You're buying bonds because of the future coupon payment. You're buying property because of the potential rent income if you were to rent it out. So property, right? The value of property, the price development of property is a derivative of the net income of the future cash flows after taxes, after depreciation, after maintenance, after all of those kinds of things. Now, the prices of the property market are, of course, determined in the same way as any other market, demand versus supply. The difference for the property market is that the drivers of demand and supply are very, very mixed. You're getting a mixed bag. You don't really get a clean bet. If you're buying the stock of a company, you've got a very clean bet, right? You think about how could these earnings of the company develop? When you're buying the bonds of a country, you also have a very clean bet, right? You're mainly betting on the government, you're mainly betting on the economy, and you're betting on interest rate development. When you're buying property, you're buying all kinds of factors. And those factors all get wishy-washed away, and very few people actually analyze those factors before buying a house or buying a flat. Now, why should we be interested in property in the first place? I believe the main reason is leverage. One can get an ungodly amount of leverage with property. You can borrow years and years of income. You can have a very small down payment, if any, and you can get massive price exposure relative to your wealth and thus potentially increase your wealth a lot, but also getting stuck in investment for a very long time if you do it wrong. So the potential opportunity, the potential chances with property are very, very high. And that's why we see so many millionaires that have made their money with property, simply because of the leverage. So the prices of the houses are not necessarily going up that much, but relative to the down payment, relative to the equity in the house, they do, right? If you've got only 10% down in a house, and then the house goes up by 10% each year for the subsequent, say, 3 years, suddenly you've 4x'd your down payment. And what happens is people tend to be saving up several years for that first down payment, right? So you're saving up a lot of money and then you're putting all of that money on a 10x bet, right? It would be as if you would buy for 10x, say, the S&P 500. But you can't do a 10x leverage with that much money on the stock market. And that's why the property market is potentially interesting. There are opportunities because of the leverage, but because of that, you can obviously also burn yourself quite massively. Most people don't necessarily sell their property when it goes down, right, when they are in negative equity. Most people simply just continue holding it, and as long as you continue doing the monthly payment for your property, it's all fine. You will not get thrown out of your house. So it's all just paper losses, and people tend to hold over those paper losses. But yeah, then you're pretty much stuck in that investment, right? You can't really sell, and you're at the mercy of all of those factors that impact the property price. Now, I want to talk about those factors because there is this ungodly amount of leverage in the property market. Interest rates actually do matter quite a bit, right? The affordability of a house goes down massively as interest rates go up because the monthly payments go up because you've borrowed so much money. In other words, high interest rates are very bad for property prices. But then one might wonder, why isn't there a very, very strong correlation between interest rate development and property prices? The reason is property is comparatively illiquid. So we do see a strong correlation between the number of property transactions and interest rate developments. So when interest rates go up, then the number of transactions tend to crash, and vice versa. When they go down, there's a lot of movement in the property market. But just because interest rates go up does not necessarily mean that prices have to come down, even though affordability gets worse. And that's because when you bought your house, and you might consider selling it maybe to buy a new house, right? Very few people actually own a property to then sell it and then rent again, unless they are in some kind of crisis situation, right? Unless they bought a big house and then they have a divorce and then they need to downsize. Then sometimes people move from being landlords to renters again. But most of the time, people simply just upgrade their houses. Now, what happens when interest rates go up? Of course, you could sell your house, but then the affordability of that potentially larger house also gets worse. So people simply just stick around. There's no demand, but there's also no supply because nobody wants to sell because you can't buy anything new anymore. So in other words, if interest rates are high for long enough, let's say for a decade or two, then prices could crash. But if they're only up for a year or two, then usually prices stay where they are. So there is a real price lag in the property market, a lag that we don't see in any other market, right? When interest rates go up or down, this instantly impacts the stock market. It instantly also impacts the bond market. It does not instantly impact the property market, at least the prices of the property market. Only the number of transactions get instantly impacted. So interest rates is one of the many determinants of demand versus supply. But there's also a very, very significant cultural role in the demand. The affordability of a house or of a flat is way better in Germany compared to, for example, China. And the reason for that is 100% cultural. Germany is a country of renters. This is where I am originally from. Normally, people don't buy property unless they're really, really wealthy, unless they have saved for a long time. It's an optional thing to do in life. In China, that's different, right? In China and in Hong Kong and in many other Asian countries, but especially in China, you need to have a property usually in order to get married, right? So a potential wife or the parents of a potential wife, they might ask you, are you safe? Do you have proper education? Do you have a nice career going for you? And have you been able to pay for a down payment for a house, right? It's very materialistic to a degree. It's not as romanticized as in the West. Thus, the property market is way more important. Thus, affordability is much, much worse in China. Thus, the prices are very high. And thus, there's also way less wiggle room compared to other factors.
The main problem with crypto YouTube is conflict of interest. Too many YouTubers shill garbage, promote garbage, and fill up their pockets in the background. Not this channel. Instead, there's simply the offer where I share my skills, my perspectives to you, and where I also share direct access to me, where you can ask me any questions. Feel free to check it out. The premium membership link is down below.
One factor, for example, that I believe is very, very important is demographic. Because why do people buy houses? People buy houses usually for their own use first, and that often happens to marry or then to settle down with kids. Right? You would buy a house because you believe your kids should have a stable place to live. They should always go to the same kind of school, and that's why people buy houses. Now, if there's less and less people that are interested in having a big family, then all of those houses far away from the city center are not going to do that well, right? There will be way less demand. And the houses, they don't go away, right? Houses have a relatively long lifetime. So you're building all those houses, but maybe demographics can't catch up. The next generation doesn't have as many children. Then property goes down. At least the large property outside of the city center. Other property, right? The property for the singles that work very hard in investment banking, that want to build up a property portfolio, that simply just buy very small units very close to the office buildings. They might be doing fine in that environment. So you're buying cultural aspect, right? As in, is it fashionable nowadays to own property? You're buying demographical aspect, Is it fashionable to have kids right now? You're obviously also buying economical aspect, as in how well is the country as a whole doing? Because if there's a lot of unemployment, people are unlikely going to buy houses. And you stack this all on top of global monetary policies, of US M2 expanding, of interest rates going up and down, together also with local politics, right? You also have local politics that impact the property market, as in what are the local taxes on property. If property prices are currently very, very high, maybe the government is going to introduce another stamp duty, or maybe they're going to make it harder for foreigners to own property. Whatever it is, right? You're buying a whole bag of stuff. Property is a highly financialized asset. It is not just brick and mortar. The price of a property is not determined whatsoever by its building cost. The price of a property is its future cash flows, and that's determined by all kinds of things. The price, or let's be more precise, the value of a property is way more determined by its future cash flows. So when it's not a clean bet, right? When it's not a clean bet like interest rates with the bond market, or a specific company, a specific industry with the stock market, etc. When we don't have a clean bet with property, why are we actually interested in this? Because who wants to really analyze all of those random factors, right? Who wants to be an expert in demographics and in global politics and in local politics and in all of those kinds of things in order to determine a fair price for property? You potentially also have to become an expert in general in comparables, right? As in, is this house cheaper than the other one? You have relatively low fungibility within property as well, right? No property is the same as the other one, right? One house might have a slightly better location, the other house might be slightly newer or might have better furniture, all kinds of factors to analyze, very hard to find out what a fair price is. And because of that, there's also a pretty broad range of prices. And so if you buy something that's not very fungible, you don't just buy, say, the apartment in the huge high-rise, but you're buying a house far out from the city that's way harder to price. If you're getting into something like this, then you have to also get on a pretty steep learning curve. You cannot just buy after doing a few hours of research. You have to become a semi-professional in this whole game, especially because you're exposing yourself to so much price volatility relative to your net worth, relative to your income, if this is your first big investment. So I do all of this. Again, it's cultural reasons. It's because banks are only okay with borrowing you so much money in the property market. You can't lever up with that much money relative to your income in any other asset classes. And this is where the opportunity potentially lies, right? Opportunity comes with risk, but if you're a market participant that's above average informed, then you should be able to also beat a market like this, especially a market that isn't 100% fungible, right? You're not just trading currencies here, right? You're trading an individual unit. And when you've got things that are very different in nature, you do have a bit of wiggle room. You do have potential deals every now and then. It's very similar to, say, buying and selling cars, right? With cars, you've got the same thing. You've got different mileage, you've got different specs, you've got different ages, you've got different models, you've got all kinds of different things that then in the end determine what a fair value is. And then you compare that, of course, to the price that you're getting offered, which might be off because the counterparty might not know about how to properly price all of those factors. Property is the exact same thing, just that the stakes are way, way higher. So what happens in practice? In practice, of course, people don't analyze all of those things. They simply just look at the individual situation. They think about, does it make sense to buy this house? Do I want to modify this to a degree that a landlord would not agree with? Do I want to have certainty in the place where I live? And then the decision is not necessarily an investment. People just regard it as an investment because over time the price tends to rise. That's, by the way, not because the property becomes more expensive. It's because fiat becomes less valuable, right? So you do want to have a lot of leverage because all the debt deflates, right? As long as your financing costs are lower than monetary expansion, which is around 7% per annum, right? If your financing costs are below 7% per annum, then you tend to make money because the debt on your property deflates. But that, on the other hand, means that it doesn't make much sense to own property outright. It makes way more sense to simply just have a lot of devaluing debt. That's where the actual ROI is coming from. So in practice, people simply just buy because they want to consume the house, they want to use the house, and then people get accidentally rich, right? Because again, there's so much leverage involved, and that debt devalues over time. So what do we take from all of this? I want to share my own personal opinion on all of this. again, this is not a property channel. I am not a property expert by any means. I just think about investments all the time. I think about money. It's something I enjoy doing. That's where I come up with all of those conclusions, what impacts the property market. Simply just thoughts around this. It's not that I am the perfect expert in estimating the value of your property next door. But here is what I personally believe when looking at all of those factors. I believe that demographics in most countries are pretty poor. So you don't necessarily want to buy a flat in China, I believe, especially if the return on investment, if the rental yield at least, is not very high, which is pretty much across the board in China. You also don't want to buy a house in the countryside in Japan because the demographics are very poor. Very few people move into Japan because it's a very isolated culture to a degree, right? You have to learn the language. And even if you do, you're not really properly integrated. You're always the foreigner. So there's very little growth from people outside that move to Japan. So Japan can't make up for the low birth rate with immigration. And you also don't want to buy when there's still a lot of price lag in the market, as in when interest rates are high, but prices of property haven't yet come down. And this is, I believe, the current situation as well. So in theory, what makes most sense? In theory, right, I think it makes most sense to buy a property in a country that still has a growing population base. So that could be, say, a medium-tier country. So that could be something like, let's say, Vietnam or Thailand or the Philippines, or maybe somewhere in South America. You don't want to buy necessarily in a developed world. Now, the problem, of course, with those developing countries is the political risk. So ideally, you want to live there for several years and really find out how high that risk potentially is. Now, this is easier said than done, right? You can't just live 2 years in 10 different countries to then decide where to actually buy property. But in theory, right? In theory, it would be best to know about the local politics, to have an idea of how risky it would be that flat might get taken away from you, especially as a foreign owner. But this is, I believe, where a lot of opportunity is, right? It's in countries that aren't yet that much developed, that there's not even any population growth anymore, because there tends to be a lot of correlation between the two, right? The more developed a country is, the less population growth there is, and the worse this is potentially for property. So I would not necessarily buy in Japan. I would not necessarily buy in South Korea, at least in the countryside. A small flat for a single person in the city center is, of course, a different game. I also think the ideal scenario when to buy is when either interest rates are super low and you can lock in those interest rates for a very, very long time, or alternatively, if prices crashed, because then you can lock in those low prices with very high leverage. So you either want to lock in low financing costs and then have potentially a positively cash flowing unit that you can rent out. Alternatively, you want to lock in super, super low prices where people are forced to sell, and you buy at that point in time to then wait for a stabilization of the market in the future. Again, you of course want to buy the markets that are long-term very bullish, right? Where you're long-term also somewhat bullish on the economy. So if you think that in the next 5 to 10 years, nobody is going to move to that country, or if you think that that country doesn't have any kind of significant export industry to also stabilize the currency, etc., then probably makes sense to rather stay away. Yeah, so hope this video gave a few new anchor points to think about this market. A lot of things people don't really discuss. If you enjoyed this, give this a like. It helps the channel grow. Feel free to also subscribe. I publish videos regularly. Last but not least, there's also a Telegram channel. It's down below. The link is down below. Feel free to join there as well. Looking forward to chatting with you. Cheers.